content of this podcast is produced for entertainment purposes only and is for informational and educational use. It does not constitute financial or investment advice. You should not make any financial decisions based on the information provided without consulting a qualified professional. All opinions expressed are solely those of the host and guest and do not reflect the views of any company or organization. The hosts and or guests may currently own, have previously owned, or intend to own securities discussed in the content. The content produced here belongs to Daniel Adreev of 18 Degree Journal and cannot be reproduced or used without prior permission. We do not wish for this content to be used for AI training and do not give such permissions. For this episode, we also have an additional disclaimer. Please pause the video and take a look. Thank you. Hey everyone, thanks for joining us today. I really appreciate every single one of you. I also want to wish everyone happy holidays. You know, Christmas is around the corner, New Year's around the corner, Hanukkah I think is this weekend. I could be wrong, please don't count on me. Today I have a very special guest for all of you. Someone that you might be a little familiar with if you have been reading my letters, but I don't judge. So he's the man who has delivered 9.6 returns since opening his fund in 2011 with only one down year. And I don't know how impressive that is. Very impressive, especially, you know, I've spent a lot of time reading other valuers, and this is a track record that has stood now over a decade and I think almost a 15-year anniversary. Someone who's managed a fund from a simple funds and has grown it to be his own business and runs it with the siblings here and there. And, you know, from what I know, they don't fight too much, which I think in itself is very, very impressive. And I know that one of his accomplishments that he has perceived more than once in his writing and in publicly saying that his most important achievement is being an amazing father. So I think it's someone who is really worthwhile to look at and to study. He has given back to the community either through his write-ups, through his discussions, through his town halls. He has also sponsored internship programs to try to build up the next generation and has really one-stepped the whole Berkshire playbook, but with a little Canadian twist. So please welcome Michael McCloskey of GreensKeeper Capital. Michael, hello.
Hi, Daniel. Thank you for that introduction. I'll try and live up to it. I'm not sure I'm worthy of it, but I appreciate the kind words.
Oh, I think you're really much worth it. So I think the audience is familiar with you, but maybe, you know, give a small introduction with you, 2-3 words. Just say hello to those who may be finding about you for the first time.
Sure. I run a firm just outside of Toronto, Canada, out of Oakville, and I've been doing it since 2011, as you said. Just borrowing what Buffett, Munger, Ben Graham, Phil Fisher, my heroes as value investors have taught, and just try to put that to work in practice with my own money. And then as the firm has grown with my family and then other investors that have joined. So I'm still learning and 15 years into this journey, this part of my career, and I'm sure we'll get into that. But I'm happy to go wherever you want in this conversation, Daniel.
I appreciate that. Well, 15 years, wow, if it probably feels just like yesterday you probably started, right? Time just flies. Does it feel like, 15-year anniversary, or does it feel like you just started yesterday, or, has the business been growing? It feels like a different business every day.
Yeah, well, it doesn't feel like it started yesterday, that's for sure. And it's come a long way. It's interesting as my sister started working with us a couple of years ago, and as she started to peel back the onion, why'd you do it this way? Why'd you do this way? And she's used to working for really large companies. I'm like, because I started the business, it was me. And so you learn to get things done in different ways, and it might not have been optimal 15 years on. So we start to invest and make some changes. But it's been a really interesting journey, and most of it good. There's always some challenges in any kind of business and in life. But generally it's been a lot of fun, and I get paid to learn, which is something that I love to do. So I'm doing the right thing, in my opinion.
I bet you are. I wanted to ask, maybe a little pivot, but maybe not. I know you work with another assistant, also named Michael, not to confuse everybody. You have Michael and Michael. I could be wrong. So how is it now, you started alone, but now you're working with somebody else. How has that changed the dynamic?
Sure. We've got a really good relationship. You mentioned I have a summer program, so I get a lot of people reaching out to me from time to time, including you. That's how we met. You reached out, and I don't always reply, but some people, strike me like you did as being very serious and have a hunger for this business and know what you're talking about and eager to learn. And so my mentors have been very generous with, I mean, Buffett gives it away. He just tells you how to do it. You just got to do it, which is the hard part. But Michael was one of the graduates of our summer program. I think I had 8 or 9 summer students work for us. And he was special. You know, he saw, he had read all the same stuff that we all read as value investors. But we were just very compatible in terms of he's conservative. You know, we don't like a lot of debt on our personal balance sheets or with the companies we invest in. So how has it changed? I'm jealous of him because he gets to spend 95% of his time researching stocks. Whereas when you have a firm, I have employees to manage and payroll and clients and compliance. And so there's a whole bunch of different hats that you wear in this business, and which pulls me away from what I really love to do, which is, you know, getting into companies and valuing stocks and working on the portfolio. But it's been great. It's fun to watch him grow. He's completed his CFA level 1 and 2. He'll be done level 3 next year. And as you can probably tell, I like teaching, you know, and just passing on. There's nothing, I don't have any great insights that I may have come up with. I'm just passing along the things that I've learned and from the greats and in my 25 plus years in and around the industry. And so we almost always see situations the same. There might be a little nuance here and there, but it reminds me a little bit of Buffett and saying that, you know, he and Munger never had a disagreement in their 50, 60 plus years together. I think it's going to be a rare situation where Michael and I can't see us ever arguing. But even when we look at a stock and what the risks are and you know, sometimes there's a little nuance, but we're almost always, we see the situation the same way. Which I think is a good and a bad thing. It's a good thing that, you know, hopefully we're putting the framework properly, but you almost want to disagree. You want to have that devil's advocate from time to time looking at something. So yeah, no, it's fun to watch them grow and make me sharper. You know, part of our culture here is for all of them, our employees, Michelle, my colleague who's worked with us from 2017, she's my assistant. But sometimes I'll ask her to do something and she'll push back and say, I shouldn't do that. You should do that. And here's why. And so that's our culture here is, you know, seniority doesn't matter in our business. It's about being right. And so everybody is comfortable speaking up and correcting me or someone else and in a respectful way and just trying to make it better. So, yeah, no, he's doing great. And I think he is going to be a fantastic portfolio manager down the road. He's got all the right tools and he's putting in the work, boy.
Yeah, it's definitely nice to probably, you know, it reminds me, I forget whose bibliography I was reading, but about the yes men culture in boardrooms.
Yep.
And you just described exactly the counterintuitive, how that you're countering that, you know, having people push back at you probably helps a lot. And it seems like, you know, though you're being humble about not teaching him, but just repeating the grades, I'm sure he's learning quite a lot from you too. Do you think you're going to keep growing, or you think you guys work better in pairs? Like, I know the usually investment, they say, is a lonely business. But also, you know, as you said, Buffett had Munger. They bounced ideas. You know, he called him the abominable no man. What do you think?
From what I've seen, Daniel, I think management of a portfolio by committee is not a good thing. I think you want to keep it really tight. I had a conversation not that long ago with someone who's probably starting their own firm and came from a place where there was a committee. And I could tell that he was frustrated by, you know, not being able to do what he wanted to do with a portfolio or, you know, things were going into the portfolio because of political reasons, and especially as firms get bigger. Ultimately, the returns of a portfolio should be the based on the decisions of 1 or 2 key individuals, and those 2 individuals have to be in lockstep in terms of how they see the world and how they go about it. And if they don't, then it's not going to work. You know, I've had great students work for me who are very smart and worked hard, and I think that they can be good investors, but they weren't value investors, in my opinion. Just the way they saw the world, or they like debt too much, or really early stage companies. And there's nothing wrong with that. There are different ways to invest, but you got to marry, the team has to be very in step, and it also has to match your personality. I think if there's a mismatch between who you are as a person and how you invest, it'll show up ultimately in your results. So, you know, I think you got to have all these things align to do a good job. But my bias is for a smaller team rather than a larger one when it comes to making the decision.
Well, kind of thinking it through, but I heard, kind of, obviously that's always awkward because it's a one-way stalking interview. I'm here, everything I found that you're
Yeah,
talking, nothing. So my question is kind of,
yeah.
I know that
Your
Michael,
due diligence is impressive, by the way.
thank you.
I'm not sure if you talked to my parents, but yeah, I wouldn't be surprised if you did.
No, we respect everyone's privacy, only what's publicly available. But I know that Michael is studying to be, God forbid anything happened to you, I'm assuming Takeover, and he's going to be a portfolio manager also in the team. So, but as he raises, we'll call it, I don't know if it's proper framing, but an authority through your firm. Do you think the decision process will change, or at the end of the day, you'll have the final word, or sometimes he will override you? Like, how would that dynamic actually work as you guys, as both of you grow?
Yeah, I'm hopeful that that I don't get hit by a bus, but if I do, I think a year plus from now that we have a backup in house, and I think he gets it. Michael just needs time, and I don't know that the dynamic will really change. As I get older, I'm in my mid 50s now. I don't have the energy that he does or that you do, Daniel. Like I'm still go pretty hard, but not like I could at your age. I have more experience now, which helps with the judgment. Um, but like I said earlier, I can't see a situation where he would want to invest in something that I didn't, or vice versa. Usually when you get through our process, as management, is it a good business? Um, can we project what is it within our circle of competence? Can we project what it'll look like in 10 years? What are the risks? We almost always see it very similar. Sometimes we may differ a little bit in terms of position sizing and how cheap it is. But I would be surprised that even 5 or 10 years from now that we would see a situation totally different. It's possible, but I think it's important. Look, ultimately, I want to grow the firm and I want it to outlive me if possible. And so to do that, young people who are talented, I think you want to teach them as much as you can. And I hope they surpass me, to be honest, in terms of their ability. You talked about my track record, and I kind of look at it as 15 years. I've done an okay job. I'm not going to be in any Hall of Fame. I hope he's better than I am. And we get somebody from Canada who is on the map like a Buffett, and I haven't been able to do it. I think I've done an okay job, as I said, but it gives me joy to just see what he's capable of. And if he turns out to be better than I am, that's terrific. Then I should pass the baton and give him, more autonomy and be more of a sounding board. And I think the culture here in my relationship with him and with my other colleagues is that we're going to have respectful discussions. But even Buffett, at 99, he's passing the baton. He knows he's past his best days, and that's a mature thing to do, in my opinion. And he's going to be there if Greg wants to talk to him, but Greg doesn't need to talk to him, right? He's ceding over that authority, and I think that's when somebody is ready. I think you do them a disservice by not giving them that level of authority because young people want that, right?
Yeah, definitely. I don't know. Buffett is doing it very willingly. You can see him being very reserved about leaving. You can see it pains him, but I think you're right. He's more mature to recognize that it's time. But again, I
It was
could be.
his decision.
Yeah,
And he sprung it on the board and on everyone else. The only person he shared it with before he talked about it at the annual meeting last year was his children. But for several years, I've been going to the annual meeting for many years, and it's not the same. When Charlie was alive, the two of them when they were younger, I mean, they were. It reminds me a little bit of you when you talk, Daniel. You talk so quickly and have so much energy, and just as we age, you slow down. Even your mind is still good, but it doesn't work at the same CPU speed, or clock speed. So I think you got to be self-aware to know that if someone's better, then that's the right thing for the client, and that's a good thing.
yeah. I think now that you mentioned, I didn't think about it, but I was re-listening to their. I think on Spotify, NBC or who got their archives.
CNBC, all the
CNBC.
historical annual reports
Yeah, and
or
I
annual
think
meetings. Yeah, yeah.
and I think I just realized that I would up the speed, like have playback speed, without even
Yep.
thinking about it too much. And I think only now I finally clicked that maybe that's why. You said that you're trying to build a fund to grow your legacy to let it keep going. Do you have like an end goal of what that looks like? Because right now I know right now you're over 100 million assets in management. Is there a goal where you think it's enough? Is there? And the reason I'm asking this question, I recently
Yeah.
had the pleasure of restudying Nick Sleep, and he had a very good letter. on the
Yep.
ethics of growing your fund and how that's actually diminishing results for past investors who actually believed in you. Because just the math wise, if you have a small position in something and then you get a lot more money and you can't put it back into that position, the math of it just diminishes returns over time if you don't see opportunities, of course. So what do you think about that?
That can be the case. Part of it depends on your investment style. Can I deploy additional incremental capital into the ideas that I have? And it's, when I look at what Nick owned, he owned Amazon. He only owned 3 stocks: Amazon. I'm trying to remember the other, Berkshire, and what was the third? Was it Google? Costco. All 3 of those, he could be running another $1 billion and not dilute. He could put it to work. But if it's in a fund, I guess you could argue, well, now you're diluting, you're buying it at higher prices. So the way that I've dealt with that is, one, my firm today, we're about 167 million. About a third of it is the fund, and 2/3 is separately managed accounts. So a new client that comes to me with any kind of size, I just put them into a separately managed account, so we can buy, whatever stocks are appropriate for them, given where the market is at the time, and it doesn't impact our legacy clients. And I don't have huge inflows or outflows where it's really, I've had that issue. I think the bigger issue is if I thought that like if we had so much capital coming in, we don't, but if we had so much capital coming in where I couldn't put it to work and it was diluting my ideas or my strategy, then I would cap it. I'm one of the largest clients of the firm, so I want to deliver decent returns. But with my style personally, I don't see that we're anywhere near that. I think we could run billions of dollars in the types of companies we invest in, with maybe 1 or 2 exceptions where I couldn't buy them in that kind of size. So I think we're a long way away from that being an issue at GreensKeeper.
And from what I saw, you mostly hold large caps. Is there a reason for that? Like, do you prefer the bigger companies? Do you think they're more transparent? Or are you open to, if something just doesn't make sense, to look at a smaller company?
Yeah, so it's yes and yes. When I look at large caps, usually you get a better management team, not always, but usually. And usually the businesses are better. They've been proven, the Visas and Googles of the world have been proven. Um, I struggle to really read management teams. Some people have that ability to sit down and say, is this person honest and a good capital allocator? The way that I do it is just to look at what they've said historically and then what they've done. I look at their track record, either at the existing company or prior companies. I look at the incentives that the board puts on them to see, incentives drive behavior. So with a large company, my preference is always to own the best types of businesses, the Visas, the Googles of the world, the American Expresses, just because the business is so solid. A bad manager can still partially screw it up by making bad capital allocation decisions. And so I'm mindful of that. And we might get into Meta, and I've owned it at times. And I think that he was making those kind of bad capital allocation decisions, which led us to sell the stock. With small cap companies, I'm not opposed to owning them. All else being equal in terms of valuation, big companies are generally safer because they're proven. They tend to have better balance sheets. Management, it's harder for them to screw it up. Um, they're just more established. So there are times when big caps are being given away. When I started the fund, big caps were not as expensive as they are today. So that's where I gravitated. All that said, sure, I'd look at Buffett bought a Sanborn Maps back in the 50s or 60s. If I saw $100 on the floor and it would happen to be a small cap, I'm not opposed to it. And we own some companies today. We own a small Israeli tech payment company that it's a small cap, but it's the Visa of Israel. I mean, it's an amazing business. I worry more about that company, about the management team and capital allocation, because they're starting to go into some areas that are adjacent to the core business, but there's a big management has this plan to grow the business in ways that aren't core, which introduces a lot of risk. And I don't have influence, right? We own maybe 2-3% of the company. So I get more nervous with a company like that versus owning the mothership, the Visa. I'm pretty sure the management team's not going to do anything crazy, or the board will stop them. Small cap companies can have their boards captive to what they want to do. And it comes back to, I've been in boardrooms as an investment banker. Nobody wants to tell the CEO that he or she shouldn't do something that they really want to do. I mean, it's a social thing that's kind of weird. And so with small cap, I think you're taking those risks. If I'm compensated for the risk at the right price, I'm not opposed to it. But all else being equal, I probably gravitate more towards mid to large cap.
Yeah, that makes sense. But, you kind of mentioned being an investment banker, and you don't have a lot of stories online about being an investment banker. Do you want to share a few? You did, hint at it at one point that you do share some of the office, but of course we can skip it if you'd like. But if there's anything,
No, it's fine. I joined after I was a lawyer. I joined an investment bank. It would have been in 2002, so I would have been in my early 30s, and it was a young bunch of men and women, all around the same age, that were. We took over the business from Eric Sprott. Eric started at Sprott Securities. He then wanted to focus on asset management, Sprott Asset Management, which was the split. So we ended up doing a management buyout of the brokerage, and that's really where I learned the business. And we had a lot of fun. I mean, we're young people, we're all working hard. It's very intense. We'd play jokes on each other. One of our analysts, Aleem, he'd come to work one day and his whole office, his computer and everything would be set up in the bathroom. We were just innocent things. But I mean, we made a lot of money because we did a lot of resource financing, oil and gas. Our Calgary office, or metals and mining, my colleague Darren in Toronto. So it was so much fun to just grow that business. It was incredibly intense and stressful, and you're competing against the banks in Canada, which is very difficult. But we just, often we just out hustled them, and we had a great ride. In terms of stories, like ones that I can share, I'll share one. So we did I did the only, or at least at the time, it was the first hostile takeover that our firm ever did. For Jerry Zucker, ran a company, I think it was called the Intertech Group, out of Carolinas, but his chief operating officer was a Canadian, Rob, who we just happened to meet. And we worked on, this is back when their income trusts were really popular. Every business that generated a lot of cash flow was becoming an income trust. So we looked at one of his entertainment businesses, and that didn't work out. And I just remember saying, "What else are you looking at?" And I said, "Well, we're thinking of taking a run at Canada's oldest company, the Hudson Bay Company." And so we got that mandate to advise them on the hostile takeover bid. And I remember we were rebuffed by management where they didn't want to allow us to buy it, but then they started running a process. They hired BMO, their M&A team. And I remember we going to dinner. Jerry and his team were up in Canada. We had dinner one night, and so we were on the outside. And then finally, BMO, they ran their process. They kept us at arm's length. We had made a bid in the market, I believe, at whatever price it was. And they said, you're not coming into the data room. We're not talking to you at this stage. And all of a sudden they changed their tune to say, okay, well, you can come into the data room, but you got to raise your bid by 50 cents a share. And I remember Jerry going around. We were actually, one of my colleagues, Winston, came and got me. I was in the shower at my gym, and he says, "Jerry wants to talk to you." So I got dressed and came back to the office, and he wanted all of our opinions on what he should do. And everyone was kind of telling him, "Well, you should raise your bid, right? He wanted the deal. I got it." And I remember being the only one saying, "I wouldn't raise your bid." And he said, "Well, why not?" I said, "Because I think your bid is good. And if it wasn't good, he wouldn't be talking to you. So I think your bid is good." And ultimately, I think he made the decision to raise the bid because he really wanted the deal. And that's fine. That's a business decision. But, it proved in hindsight that we were right. And one of my partners in investment banking, David, had back channeled. Part of what you do in investment banking and an M&A situation is you're just getting intelligence, right? You're talking to people in the industry. You're trying to figure out what's actually going on with these processes. So ultimately, he raised the bid. We got into the data room. We won the deal, and we bought Canada's oldest company, which was kind of neat. So it's M&A is interesting beast. It's emotional. Warren has talked about it, but they take on a life of their own. They're emotional. It's a little bit like an auction. You go to an auction and people overbid for things because they want to win, right? And CEOs and boards are kind of competitive, but it's interesting to watch it from the outside. And as an M&A advisor, I don't really have skin in the game, so I can be a little more objective about it. But I've got a million stories, half of which I probably can't tell in a podcast. In investment banking was so much fun with these young people, my partners, and we argued and fought sometimes, but we made a lot of money, and I really learned the business about how the industry works in the sell side, and it was a lot of fun. It was exhausting. After 15 years on Bay Street, I left for a reason, because it wasn't as much fun, and because you got to have your energy level day after day and be in the office at 6:45, ready to bite the ass off a bear, as Ace Greenberg used to say. So it's a great way to learn about capital markets and investing and how things really work.
Do you think a lot of what you learned there really transpired to what you do now? Like those skill sets?
Absolutely.
When any like in particular that you really worked out that you think right now like you would have been a completely different investor if you haven't done that?
I think how I interpret sell-side research, having watched, and I still see it today, you see people right out of school, 22, 23, telling CEOs and boards that they're doing it wrong and how to run their business. And I think that's kind of amusing. And look, sometimes they're right. Sometimes they're absolutely right. But you got to have a little bit of hubris to do that at that age. I think knowing the biases of sell-side research, like if you're a sell-side research person, you don't want to upset the company, because if you upset the company, that means that the investment banker is going to get mad at you. They might cut you off from even talking to you as a research analyst and talking to you about the business, which is not good for you. The investment banker, where you really make the money in the business, is on the investment banking side. Research is a cost. Banking and trading are cash generators. But in today's day, I think trading costs have gone almost zero. Investment banking is the only place you make any money. So upsetting an issuer by issuing a sell report is, can damage your relationship. So they say hold, to use a euphemism and to be politically correct. And they try and say, it has nothing to do with management. And they say all these things, it has to do with valuation, which can be true. So the way I interpret sell-side research is they have access to management. They tend to focus on 15 names, and they really know a sector deeper than I can go. So it's helpful for the data, but I almost never give much weight whatsoever to their target price or their view on where the stock is going. I just use it as an input into our process. So it helped me with that. It also helped me to understand, management teams and where they're coming from, and the challenges that they face, and just the incentives in the industry. If a trader is calling me with an idea, a small size firm in Canada, I know that they've got a problem they're dealing with. They're not doing me a favor, right? They're trying to get rid of a problem. So it just helps me to not be naive about what actually goes on in the industry. I use that every day. I use my M&A skills to understand the law and how it works and how these transactions are going to play out. I use my legal skills to understand, like reading public disclosure documents and what they really mean, reading between the lines. And law taught me how to write too, which was helpful. So all of my careers have really, I use them every day, Daniel. In this business, as you know, you take ideas from law, investment banking, psychology, science, and you integrate them when making business decisions or stock decisions. It's weird. This job is kind of weird in that way, that you're trying to make really good decisions, but you bring in mental models, as Charlie would call it, from many different disciplines.
Do you think the dynamic of how the sell side research works hurts the investment industry overall for investment confidence? Because then maybe we don't believe the investment research as much. We discard it, and it's basically becoming, and not to politicize it, but maybe some marketing material essentially for investment banking business. So do you think that hurts the industry?
No, I think it's a net positive. They're starting to talk about rolling back some of the things they did after the .com era, which is before your time. Frank Quattrone, I think was his name. I mean, the analysts were saying one thing in private, that this is a piece of what company, and then they were writing glowing reviews. I mean, that's just horrific. You're lying to your clients. What they've done since then is they've been more nuanced in how they worded things. Ultimately, I think they still add to the knowledge of the sector. Most people that don't do this like 60, 80 hours a week, if analysts didn't put out information, all you have to rely on is what the company's telling you, and they have a bias, right? So I think at least an analyst can give you perspective on how a company is valued relative to its competitors. They can educate people on what's happening in the industry, competitive threats. As long as you read it knowing that there's that inherent skew or bias towards being favorable towards a company and a conclusion, they're still helping you understand the business and the industry. And I think that's a good thing for investors. Most amateurs, I'll say it this way, most amateurs that have a day job and families, and they don't have time, but if they want to invest on their own without indexing, which is probably the better way to go, if they're buying individual stocks, in my experience, talking to them, like people, sometimes it's as easy as, well, I go to Costco and there's always a the parking lot's always full, and so I'm going to buy the stock. Like that's how sophisticated it is, right? And so I think by adding the ability for people to have research done by professionals that do this for a living and focus on it, I think net it's a positive. But like most things in life, it's nuanced.
Have you ever got anything out of those reports that you didn't know before?
Absolutely.
Yeah.
I still read them. I still read reports from JP Morgan and other analysts. I think everyone can teach you something, even somebody you disagree with, whether it's an analyst or social media is a great place to get information on a company. And if you go in even with somebody who has a different position than you, if you can, you got to, first thing you got to do is stomp that out and say, so what? Maybe they're right. If you go in with an open mind to try and learn what he or she has to say, it makes you better. And so, most of what I see online on there are sites like Seeking Alpha where 90% of what I read is not very good, but there's 10%. I'll give you an example. There's a guy on, he was a doctor on Seeking Alpha, and now we own Novo Nordisk, but GLP-1s are, incredible in terms of the market having come out. He called it years ago. He says this new semaglutide molecule, I think it might have benefit for weight loss. And this is at the time when they were using it for diabetes. And so you can get little snippets from all over the place. So everyone can teach you something if you keep an open mind, including analysts.
I'm going to pivot a little bit. I know your daughter is also kind of slowly going in a similar path as you. How do you feel about that? I know she teases you here and there, especially, about getting into her first try to business school, and you not so much. And I think she's following us.
True story.
She's following us a little different path from what I understand.
Yeah, she's going into finance. She was going to go to medicine and then decided, I think it was in her first year university, she'd taken chemistry and a lot of sciences at Western, my alma mater, and decided she didn't want to do it anymore. And she didn't know what she wanted to do. So I dragged her to Omaha on my annual pilgrimage and introduced her to a friend who was in the business, and ultimately got her an interview for a job, which I can still remember pushing her saying, did you call Helen to, talk to her about it? Oh, no, not yet, Dad. And there are a few times in your life when you got to nudge your kids a little harder and say, well, do whatever you want, but you're being dumb. Like, I'm telling you to at least have lunch with her. And she went and had lunch and came back. Oh my God, she was so excited. And then she applied for a summer job and got it. And she loved it. And she's trading derivatives now. So she works on a trading desk for one of Canada's biggest banks. It's different than what I did, which is fine. And I want her to do what she wants to do. But she loves being in finance. And I fell into the industry. I've loved the market since I was a kid. I was always interested in it intellectually, but I didn't really know what you did as an investment banker. And when I joined, I still didn't know what you did as an investment banker. We just kind of figured it out. So she's taking a similar path, but I don't know where her career is going to go. And I just want her to be happy and do good work and do what she wants to do. The beauty of finance is it's intellectually stimulating. You're well paid. It's an amazing game if you have the right mind for it and you like it. And so she does. And so I think she's doing the right thing for where she is in her life right now.
Does she understand what you do, or does she, dismiss it all?
She understands. Yeah, I manage her money, so she understands what I do. I would say that she doesn't understand value investing and fundamental analysis, maybe at a high level, but she's never really done it. What she does today is very different. So she has different skills than what I do. And that's okay, right? There's many things in finance. You got to go to what your passion is in this business and what you like to do. And we all have different personalities. She's a little more social than I am. She's more like her mom that way. So like I said to you earlier, you got to marry your personality with your investment style or what you do for a living. It just, your life is better when the two are in harmony.
I want to pivot again. We're pivoting just for fun. I know I made a joke, that you're working with your siblings. How has that whole experience been? I have a sibling myself, but but working with no friction, it's a little hard to believe.
We like most siblings growing up, we used to fight like cats and dogs, and as my mom and dad would probably tell you, but we're really close as we've gotten older. We live close to each other. there really isn't any sibling rivalry at this age. And I mean that I think that all three of us would be willing to do whatever any of us needed at the time. We're open with each other. It's a very mature relationship. And just as the business has grown, my brother, we have opposite personalities. He's very gregarious. He's the life of the party, and he's really good with people. So he's been great at just making people aware of this hermit, his brother, who works out of his basement most of the time. And as the firm's gotten bigger and bigger, I've just needed more help in terms of running the business. And my sister, the timing just happened to line up, and I talked to her about it, and she thought I was doing her a favor, and I wasn't doing her a favor. I needed the help. And she's very talented at managing companies and marketing, and she's the brightest of all of us. And so we have a great relationship where it's like my relationship with Michael or Michelle is just, we may disagree on things around the margin, but that's okay. And it's been a godsend to have help in the business as we've grown, and she's made it better. She's taken on project after project after project, and they never seem to end. So, I love my family. I'm close with my family, and being able to work with them, there's immense trust, as you can imagine. We know each other, and we can say anything to each other. So it's been a really, really positive experience. You got to have the kind of relationship with your siblings to work together where it's going to work. If there's friction and you're not quite there, then I wouldn't recommend it. But given our relationship, I have no concerns that it isn't going to continue for the next however many years. And it's been very positive from my perspective, and I think from theirs.
I'm sure they would attest to that. You did say marketing, and I know that you're more introverted, and
Yep.
your sister's probably pushing more marketing initiatives. So how does that come around? Because I know you would rather be outside the limelight. I know you had a very excellent interview with Guy Spear, and you mentioned that you didn't even want to put your name on the report, and he kept insisting that you get your name out there. Has that changed? Yeah. What are your thoughts on that?
Yeah, Guy was right. I do try and learn that you can't just deliver a good product. You got to tell people about it. It's the reason that I agreed to do this, Daniel, is, I like you, and I think you're going to do well. And I understand why you're building your following. You've got a passion for this, which I respect. So yeah, one of my to-do lists is to get out there maybe a little bit more and do a little bit more of this. But I also have to marry that with my personality. I don't have a big circle of friends. I never have. And I don't need a lot of human interaction, which can rub people the wrong way, including friends, right? Because a lot of friends, they want to get together all the time and hang out. I don't have that in me. It's just not who I am. So I need to do this for the business, but it's going to be measured. And I'm never going to be my brother in the life of the party, and I'm never going to be doing podcasts every week. And I just know that. I do like to write. So, yeah, I think if I want the business to continue to thrive and grow, I need to do it. And hopefully I have something semi-intelligent to say from time to time. But yeah, I think I'm going to probably do a little bit more of this. And we started doing quarterly town halls. I think you may have been on the last one. As the firm has grown, I'm going to need to do it more and more like this, where I'm talking to, I'm recording it and I'm talking to a broader audience. Because when I started, I could have a meeting with all my clients or one-on-one, and it's as we grow, it becomes harder and harder. And one of the hardest things in this business is just time, energy and time, and it gets harder as you grow. And so there's just a really efficient way to do it, and doesn't totally deplete my battery to do it more than, I can't do this every day, but from time to time I'm able to.
Yeah, the town hall, thank you for allowing me to join that, by the way. You kind of, I think I sent you the questions a day or two before, and then you went to the town hall answering like 3 of my questions, which was pretty funny.
Did I?
Yeah, that was timely. But I think I went into it, and, for me, I went to school during COVID. And it really reminded me of, Zoom University. Nobody has the camera on, it's silent. How hard it is, to give a town hall, and, it's like you're talking to a black screen. I know your analyst was, Michael was there, so maybe that helped a little bit. But other than that, you think it's harder than in person? Because I know you also do your annual meetings, your AGM in person.
I do that in the summer where most of our clients attend in person. Yeah, I prefer a back and forth. I think people, and I had someone reach out to me after the town hall saying, I wanted to ask you a question, but I didn't want to do it online. So for them, it's more public. I've always preferred the back and forth with clients, like at the annual meeting where somebody challenges me on something or said, why did you do this? Or what about this? Because I like to know what they're thinking, and I like to know if they disagree with me on something, or just get a chance to explain why I did something or how I think about it. So I enjoy the back and forth. I really do.
Do you think it's harder for clients? Like money, of a lot of us is very personal. Do you think like in
Yes,
this meeting, because like you said, your client, do you think because it's so personal and we associate things with money very personally, a lot of people will be scared to ask questions? Or you think as you
sometimes.
encourage this, it will be open more?
I think it depends on the person and the nature of the question. If it's relating to their personal financial situation, that's always better dealt with privately on a one-on-one call, or a video call, or a phone call, or a meeting. But if it's a general question about investing, I can remember 10 years ago, someone asking me about marijuana stocks and my thought on marijuana stocks, and you can substitute that for Bitcoin today. And, I went through my rationale, and it just helps me to think, okay, that's what my clients are digesting and thinking about in this environment. So I need to explain to them why I avoid those types of situations and why. And look, they're big boys and girls, and they may decide to put a portion of their capital to work in Bitcoin or marijuana stocks. Or marijuana, I'm like, the farmer never makes any money, right? It's a commodity. You have to brand it. The tobacco companies, if you can brand it and sell it at a premium, okay, maybe that's a good business. That was in the very early days, and it was very, very speculative. So I just steered clear of that. I think that's an intelligent conversation, and ultimately they may put some of their money into that, and some of them may have made some money in it, and some may have been wiped out. I don't know. That's just not what I do with my money or our clients' money.
Do you think that, I know some fund managers, they select their clients, so they want them to be the same line-minded. That makes it a lot easier during times.
Yep.
Do you think
Yep.
that filtering helps, or do you think that as long as you explain it and you have an open channel, it's not a big hurdle to cross?
I think it's important to have the right clients for your style of investing. I've done this for almost 15 years, and I think we've lost less than 10 clients, including people who have passed away. For one, for personal reasons, it's rejection. Nobody likes to be fired by a client, or somebody leaves. So you don't want to do it for that reason. But more importantly, it, you're just asking for trouble if you bring on a client that is not a good fit for your style, right? If somebody's going to be calling me every week asking about a decision I made in their portfolio, or why I did this, or can you tell me what you think about this stock? I don't have time to do that. Like, you're paying me to use my judgment, to scour the universe with our process, and put in your portfolio our best picks, our best 70 to 20 names. If half of my clients wanted to talk to me every day or week, or wanted to use me as our analyst to trade their own personal portfolios, that would be bad for all of our clients. I'm not spending my time where we should be. But also, if somebody wants to invest in Bitcoin or highly speculative things, and they want me to do it at GreensKeeper, like, that's not what we do. And that's okay. Again, I don't judge that may be what you want to do with your money, but that's not what we do. So we try and be really transparent about how we invest and why we invest. And I want our clients to be very long-term thinkers. And if they are, and I think it's a good fit, part of on our onboarding process is reading their know your client information, their net worth and their income. And I always ask them a bunch of questions. Regulators say, well, is this person low, medium, or high risk tolerance? And everybody checks a box, but what does that mean? So the way I answer it for people that might not be as sophisticated in investing is, well, what happens if you woke up tomorrow and your investments were down 15 or 20%? How would you feel? What would you do? So I'm really trying to understand how they would react in that situation. Because if I think they would panic, then you shouldn't be in equities, and I'm not the right manager for you, because that can happen tomorrow. And so part of what I do when I'm onboarding a client, they're interviewing us, but I'm also interviewing them. If I'm not sure if it's a good fit, I'll probably keep asking questions. If I think it's a good fit, sometimes you might get it wrong. Then you go, but almost always they've been a good fit for us, because if you read our communications, our 51 quarterly letters, and our clients get stuff more frequently than that, monthly. I'm saying the same thing on different stocks, but in different ways. I am educating them on what we do here. And they decide that we're not for them, that's okay. But if you do it right at the beginning, I think you just avoid a lot of problems for us, for them. It's just a better way to do it.
I think watching your meetings, you have like mastered the art of communication to your clients. I had a few times they come with their heat asking you questions, so you need to scale the situation. I think one prime example was you had I think it was last year. You had a question about international stocks, and the Israeli company came up, and people were like, "Why would you not sell it?" And your
Yes.
rationale around it. I think that was done very well. How do you get to that point to explain to clients that, hey, this is how we do things, and they don't agree, they want to pull out? Do you mediate? Do you find a compromise? Or do you stick to your gun, say, we go where the value is? If you're not happy with this, you're allowed to fork, but...
So with the fund, because you can't tailor it to an individual, right? You just have to set ground rules for everybody. It's about a third of our assets. I've said from day one, I won't invest in tobacco, and I won't invest in gun manufacturers, firearm manufacturers. But beyond that, everything's game as long as the country respects the rule of law, which is part of our process. But when it comes to separately managed accounts, clients have the ability to say, some clients have said, I don't want to invest in a defense manufacturer like a General Dynamics, which we own. I don't want to invest in Israel, or I don't want to invest in XYZ. And again, I don't judge. As long as I think that I can build a portfolio, I've got enough names that otherwise meet our criteria, then I'll take the mandate, and then I can do that for that client, and it doesn't prejudice anyone. There's a friend, Vitaly Katzenelson, writes, has written about this in the past, that some investors, don't want to do X and some don't want to do Y. For almost any investment, you can make a reason that someone might not want to for personal reasons, for their own ethical reasons. Often you can make the opposite argument. And so I don't want to argue with clients and try and convince them, no, you really should look at it this way. All I can do is say, look, if that's your decision, I respect it. I may disagree with it, but that's irrelevant. If I can still service your needs and deliver good returns, even though I can't include this one stock in the portfolio, then I won't. And if I can't meet your needs, because I think that you've limited where I can invest with my style so much that I'm not going to do service and give you good returns, then I won't take the business, or I'll suggest that they go elsewhere. That's never happened. But the way I look at it, if I'm investing in the Visa of Israel, some people, want to get into the politics, and I don't. I don't think there's anything unethical about running a payment network in a country, and I may not agree with the politics of the country or the prime minister at times, and you can say the same thing about Canada or the United States, and I've given what's going on in the U.S. with the culture wars, I've had some people say, do they respect the rule of law still? And I'm like, not as much, but whether or not you agree with what the current president of the White House is doing, the reality is, I think it's 60% of the world GDP, or market cap of companies, and the best companies in the world, that's where they're situate. And the Visas of the world and Googles of the world, these are global businesses that happen to be, situated or headquartered in the U.S. I'm not going to avoid them just because I don't like the politics right now. I think you're doing yourself a disservice, and capital doesn't care. So if you want to take that moral stand, that's fine. Again, I said, that's fine. But if a client came to me and said, I don't want to invest, if you can invest my money, but you can't invest in the U.S., and I'm just like, I'm a bad fit for you,
Yeah, I think if I'm not wrong, majority of your portfolio is invested in the U.S., so that would be quite the turnaround.
Yeah, I couldn't do it because the best companies in the world are there, Daniel, and we pivoted. We're probably, I'll get this number wrong, but maybe 70% in the U.S. today, down from 90 something previously, and we've found more value in Europe over the last couple of years. So that's why we pivoted. It's not based on politics or any of that. There's always going to be politicians in place that do things that we think are dumb or wrong, but as long as we're somewhere in the Western Europe, Australia, New Zealand, Canada, the U.S., the UK. If I can understand the culture and they respect the rule of law, then it doesn't matter to me that the company is domiciled there. As long as it's a good business and it's trading at a valuation that I like, then I'm comfortable with it.
I think you also not only focus, right now you have a concentration in the U.S., but you also concentrate on a few sectors. I think for me, I highlighted that historically, I looked at your portfolio, I think over the 15 years, you had a high concentration in tech, in payment networks, and in pharmaceuticals. Do
Okay.
you think that expertise comes from your investing banking days, what you were more focused on, or how did you come that that is your circle of competence? Because you seem to really stick to that area.
Mm. Yeah, I don't know if it was by design. I mean, you got to start with circle of competence, which is do I understand this industry and what's happening. When I was an investment banker, I covered technology, but I learned a little bit. I'm no expert. We're high in tech today, but some of the tech companies are Visa and Google. Those are very different businesses. Although, I think the classification just changed and now Visa may be classified as financial services. I'm not sure. But I did cover banking in Canada, and for a long time. So I do understand how banks work and the regulation. Um, and so I think that gives me a little bit of an edge. Banking is a hard industry. They're complex beasts. They're levered. They're very opaque. And so I tend to actually stay away from pure banks. But I did get to learn a little bit about payments, and I find it interesting. And I really like businesses with network effects, and payments their moat tends to be based on a network effect. So, I started with Visa and just went from there, and I just learned more and more about all these different payment things. And I mean, Guy asked me to do the podcast after I wrote a really long memo on Visa. This was at the time that I'd already owned the stock, but everyone thought they were going to be disrupted by what was happening in Brazil and with in India with their government sanctioned pay, and China's never adopted the Western payment rails, and then I think Russia's trying to push them out or did push them out. So it was kind of an interesting time. There was a debate whether or not these businesses were doomed, and I took the position that they weren't, and kind of worked out for us. So I just find them interesting. I'm prepared to invest in any area I can get my head around. Pharmaceuticals, they're not the best businesses. Like, they tend to generate a lot of free cash flow, but they've got a decaying intellectual property, so they have to continually reinvest or purchase small cap pharmaceutical or biotech companies that have come up with interesting molecules. But as the industry is consolidated, I think part of their moat now is just scale. Their ability to get drugs to market and through the regulatory process, and to all these people that are out talking to medical companies. That's part of their moat, and they just deliver so much free cash flow. I love free cash flow. I've always gravitated toward free cash flow. So I don't think I've intentionally focused on those areas, Daniel. It's just been where I found value in industries that I could understand at the time.
I think for Russia, I think they use Mir now. I could be wrong for the payment networks, and I think they connected it to China. I was just in Belarus recently, and I know that some credit cards
Yes.
don't work, but I think they block it by your through your bank. If I'm not wrong, they take the rail that is identified for your bank and the bank it, but the rails themselves work because the local issued cards are still like you have Visa and you have Mir cards, so that would be the competing
Yes.
network, but you still have both. So I don't know if the Russia is still the
Okay.
same, but I do know that's the case in Belarus at least, who's also, by the way, sanctioned, at least as of now.
Yeah, I think China never allowed the Western brands to get traction. It's a risk, right? It's a little bit like the SWIFT payment network for banks. Is if you're relying on U.S. tech, then you're always relying on, or you're subject to or vulnerable to U.S. sanctions. And if your consumers are using this every day, I can remember reading articles about Russians being in Indonesia on vacation and the Visa cards wouldn't work. So for geopolitical reasons, they want to get away from the Western networks. But they're amazing businesses.
But even when they get away from them, I think they build the business model, unless this government own it, almost identically. Like between the banks, it's almost the same fees. Of course, they have entices because it's funny. You go in the elevator, and the banks it's like they're advertising for the bank to switch to that network. Because at the very bottom, it
Yes.
says the interchange fees for the businesses if they accept these cards are lower. So I don't know if that's the
Okay.
tactic, but I found that very fascinating. For pay,
Ultimately, a government can ban them,
yeah.
right? That's the real way to get rid of them. But they can't do it if there's no alternative that's already fairly widely accepted. Otherwise, your populace will revolt, right? People don't carry cash, at least in most countries.
But that's what's interesting because I think Russia and Belarus still a lot of people still carry cash, especially the older
Is that right?
generation. Oh yeah, yeah. Because when we were there, I spent mostly in cash. Everything is accepted. The self
Hmm.
checkouts, cash goes in, no problem. It is
That's
changing.
cultural.
Yeah,
Germany's like that.
yeah. I
And
think
some of the Nordic countries like Estonia, they're almost 100% digital now. So there are still some regional differences.
I think Asia's the same thing. I think we went a while back, and also cash almost everywhere. It says card, but then if you go any shop, I think they're all very prejudiced against paying those 1 to 2% fees, even though the bank takes most of it.
I understand.
So I know for financial services, you were a strong holder in FI. I think through majority. I think you first bought it, I want to say after COVID, around 22 when it started crashing again.
Fiserv?
Yeah.
Yeah.
I think around
Yeah.
that time, and I think now you're down quite a bit, and I think you also presented it during your town hall, and I think you said that your thesis got distributed, and there's now new management in place. So can we analyze that a little bit more, see what we can take away from it?
Yeah, as Charlie Munger said, you should rub your nose in your mistakes. So I did bring it up on our town hall. So when I bought the stock, Fiserv, for those that don't know the business, so they own the Clover payment network. If you go into your local store, restaurant, pub, and present it with a terminal, that's part of their business. Part of it is running the core software for banks, a lot of credit unions and regional banks, where it's their deposit taking and loan software. They run the core infrastructure of that. And they also help those banks issue cards. They help them on the issuing side. The stock looked cheap to me. It's been a compounder. It's been growing at close to double digits, I believe, for decades, incrementally increasing their dividend over time. The balance sheet was fine. Clover was growing like a weed and taking share. So everything looked like it was lining up. We bought it a few years ago. I don't know, 2-3 years ago. We were a genius. We were up 130%, I think, at one point. Today, I'm looking at it. We're down about 35% from cost. We got surprised by it, and it's cost us about 5% this year, which has been painful in terms of performance. And what's happened is the old management team, the old CEO left to join the Trump administration. Frank Bigsignano, I think's his name. New management comes in, and within 2 or 3 quarters, the business is starting to deteriorate. And then last quarter, they did what I will call a mea culpa, where the new CEO said, look, I was still getting my arms around this business. Here's what I found. Management was trying to keep its growth record intact. So what they would do is they would add junk fees or fees to their clients to meet a quarter that weren't really adding value to the customer. And so that was creating a lot of churn. People were getting tired of it and were leaving to join into competing systems. They had deferred a lot of research and development and capital expenditure for the bank software I talked about earlier. Like they've got something like 15 different platforms that these banks are working on. They've never really integrated them and gotten them down to 3 or 4 because they never wanted to spend the money, which would impact the income statement with the depreciation or an expense. And so they're finally doing that, which is the right long-term thing. It has short-term implications to the P&L. But the thing that, so those both bothered me because the company is just managing quarter to quarter as opposed to doing the right thing. What really bothered me was they've got a business in Argentina, payments business in Argentina. And Argentina has been going through hyperinflation the last couple of years. And so that can really skew the results. And it's hard to decipher that based on what is disclosed publicly. So you have to rely on management to say, okay, how does that change your reported numbers? And instead of I would have preferred they said nothing, but they made it worse. The last few quarters, management has said, well, we're going to tell you what's going on in Argentina. There was excess inflation. And when we stripped that out, our business wasn't growing at this level. It was really growing at this level. And so I'm like, okay, well, I can judge how quickly the core business is growing when I make that adjustment. This quarter, for the first time, they basically walked the old CFO to the door and said, we haven't told you the full truth. These are my words. We're going to give you a holistic approach. And the reality was the Argentine business was probably growing 10%. The entire business was growing 10% lower because of the Argentine hyperinflation. And as I started to come down with Malay and what he's starting to do in that economy, you're starting to see what the core business is really growing at. So I feel like they lied to us. For sure they misled. I feel lied to. And as I said on our town hall, like I own the decision. It's one of those things. I don't know if you've ever read Andy Duke's work, Thinking in Bets. I think we made a good bet with the information we had at the time. I think it was a good decision. It turned out to be wrong because I don't think we had all the information that we should have had. and they're going to get sued and they're going to lose because they did bad things, but it doesn't help. You get back cents on the dollar. So, the lesson I take away from that is to continue to be skeptical about management teams and to continue to do our own work and to try and get scuttlebutt, going back to Phil Fisher. Like, it would have been helpful, I think, to talk to former employees of the company and customers and suppliers to see maybe what was going on behind the scene. We talked about analysts earlier. There's been an analyst, I think there was one of 30 who actually had a sell on the stock. He was the only one calling it, and he's gotten a little bit of notoriety for it, and good for him. He made the call and he was right. So I'm always skeptical that management's got an agenda. It isn't usually as blatant as this, is where I think that they deliberately misled the investment community. And I don't know if you're familiar with Dataroma. You've got a bunch of super investors there. Fiserv was the top purchase in that quarter. The numbers, everything that was public told you that it was mispriced, unless you knew that hidden information. Like I said, I think we made a good decision. It turned out to be a bad one, but at the time, based on what we knew. But it's humbling, and you don't get them all right in this business. But that's been a bad one, and it stings. And I don't like getting anything wrong, but you try and learn from it and move on.
I think why it came to my record, I wanted to ask you. I know in your town hall you said that you feel right now that it's under the price, still undervalued relative to, because it's dropped so much. It's not worth as much as it was before the drop, but it's still worth it. And you said that you're waiting for it to go to a more reasonable price to sell, to exit. So you are planning to exit it. So my question was, I looked at the pattern, and I know we're going to talk about Meta in a bit, but it was quite parallelism in them that you got into the position at year X, we'll call it. The stock started dropping, you added to the position, and then a couple months later you're planning to sell it. So a very, very similar pattern, very similar, story in the two. How are they different, and what are you taking from them? Because for me, that's kind of what stood out to me.
So how are they different? I'll start with that first. The stock action is similar, but how we reacted to it is different. What's changed with Fiserv is we have new information. And instead of panicking and selling at this price, I'm mad about what they did, but objectively stepping back and looking at what the new CEO is saying and doing, I think he's doing the right things. He's saying the right things. He's on a short leash. I'm going to make sure he follows up with that. But look, a business that's growing double digits consistently over decades is a compounder. A business that's more likely to grow mid-single digits is kind of interesting, but my intrinsic values come down quite a bit. So I think that when it gets close to what I think it's worth, there are probably better places for my capital. It's the way I think about it. So that it comes back more in that case to the fundamental growth outlook of the business. Meta was a very different situation. I still made a mistake with that one, but it was a different kind of mistake. So Meta, we owned the stock because it looked cheap, wrote it up quite a bit, and then Zuckerberg became obsessed, is the word I'm going to use, with the Metaverse. He changed the name of the company. He was prepared to spend $10 billion a year plus, in my estimation, at this vision of, he put out these videos of picture of Zuckerberg with no feet talking to people around it. Like, that's his vision. I don't know. The guy invented Meta, so maybe he's a genius, but that doesn't mean he's going to be a genius twice. Larry and Sergey at Google almost sold that business for a couple $1 million. And, it's hard to find lightning in a bottle twice. I think he was doing reckless things because he believed it was the right thing to do. He's one of the richest people in the world. So does he really care if his stock trades up or down? In my opinion, a person in his position cares more about his legacy and being right on the next technology shift. And they're going to do whatever it takes to make sure they don't miss it. But because of the governance structure with his ownership and multiple voting shares and how tight he is with the board, he has no checks, or very few checks in that business. If Mark wants to do something, he's going to do something. Elon's like that with his companies too. So the stock sold off because of the concerns that he was going to put $10 billion a year plus in a paper bag and light it on fire. If you think that the metaverse was misguided, which I do. And so the stock just kept going lower and lower. And I lost faith in management, which is similar, but not quite the same. If Frank was still running Fiserv, I would lose. I wouldn't invest anymore because the guy lied to me. The new one, I'll give him the benefit of the doubt, but the business has changed. With Meta, I don't think you're going to change management. He's going to do whatever he wants to do. I think the pressure on the stock finally caused him to change and start to temper his enthusiasm, or at least the way he was talking around what he was going to do with the metaverse. He didn't actually change his behavior. He still spent a lot of money on it. So I think I was right in terms of it was a bad capital allocation decision. But I think I sold too soon. I should have waited for the narrative to change a little bit and then to leave because I didn't trust management as a capital allocator. And it's interesting, the stock rebounded. It's gone up a lot. He's doing the same thing again now. It's just with AI this time. So now I actually think that AI is, an amazing technology, is going to be the future. You don't want to miss that pivot. But he's putting so much capital to work, and he's starting to use off-balance sheet debt. And he's going all in again on a different thing. I think he's still putting money into the metaverse, not nearly as much. But I think it just kind of proved my view of Mark, where he may be a technology genius, but he's going to swing for the fences because he doesn't want to miss it. And he's already going to be a billionaire, even if he blows it up. The core business is still fine, and management matters. So even in large cap companies, we talked about small cap, even in large cap companies, they can screw up the business if they make really bad capital allocation decisions. I don't know if AI is going to be a good outcome for them. My own view is I think a lot of these models are going to become near commodities. And I think there's going to be 2 or 3 players that create the core models. There's going to be a lot of other applications on top of it, but it's going to be very capital intensive. And if you blow your brains out, I see a lot of companies like Oracle and Meta that are really just, even OpenAI, I don't know. Like, they're going to burn through a lot of capital. And I think there's going to be a bad outcome from some of them. But that kind of, in my mind at least, the differences between the two. The mistake I made with Meta was just selling at the wrong time, but I still think I picked him right.
I think, anytime you see on LinkedIn becoming the new NBA draft with them paying millions for each AI engineer, some light bulb has to flash somewhere, because it just does not make sense. I think for me, at least, my background's a little more technical, and I do see this commoditization of these large language models, because I think you might agree or disagree that there hasn't been many aspects where they were successfully monetized in a way that they're very profitable. I think right now they're still very funded. I think one way that it was actually Meta with their recommendation algorithms for creation. I think Google has their own, and YouTube with shorts and odd recommendation algorithms that keep you in Christ. Same with TikTok and ByteDance. But outside of that, the applications where it was very profitable, I haven't met many. I don't know if your experience is any different.
It's still very early days, Daniel, but I think we've all been conditioned to get things for free as consumers. I think the way to monetize these things is probably the way that Google's doing it, where, we use OpenAI, we use Gemini, and we pay for it $20 a month. I'm sure they're losing money on us, and I'm sure they're losing money on others. I think maybe at a business level, the Anthropics of the world, maybe they can get enough from their paying customers to make a model out of that. But I think for most consumers, it's going to merge with search, and I think it's going to be monetizable through advertisements, not $20 a month, because I don't think most people will pay for that. I think that's where we're going to go. I don't know exactly when, unless AGI happens and enslaves us all, then it doesn't matter. I think you're going to get into the law of what is it? The law where you just, the incremental returns you're getting from the next version of the model are going to become less and less. And these models are going to look more and more the same, and they're so capital intensive. That's why my view is I heard you say your view too is they're going to become near commoditized. So how do you monetize that? I think you got to stay at the leading edge, and you probably have to use advertising. And if that's the case, that's what Google's doing, and I wouldn't put it past them. We own Google. I wouldn't put it past them to be able to monetize it. They're starting to. For OpenAI, they're going to have to learn how to do that. And a company that's doing, I don't know, they're doing $20 billion of revenue and $1.4 trillion of spending commitments. They haven't got a business yet. Now, I don't think OpenAI is going away because they have mind share with the consumer and a lot of people are using it. There is going to be a way to monetize that. I just don't know if the ownership of OpenAI is going to stay the way it is or if somebody scoops them up. I don't know. It's kind of crazy right now. But they're amazing tools and they're going to get better. I don't think anybody knows what this industry is going to look like in 10 years.
Yeah, definitely. I think instead of core model, I think the term is we use is foundational models. So there's going to be these 3, 4, 5 foundational models, and then there's going to be a lot of small companies that might, specify something on top of them for a small business until somebody learns how to kill it. But the commodity is going to be underneath. I don't disagree with you.
Yes.
Now,
the Chinese are taking that approach.
Honestly, I do use a lot of the Chinese open source models. I find them a lot better, especially for specialized coding agents.
Yes.
They make it a lot more simple than the ones we have here, and it runs fantastic. Everything's open. Of course, there's the risk of the data being tainted that they train on with certain biases, but I think you're going to get that no matter where you get the data. It's going to have some sort of bias. That's, of course, hopefully no security risks, but we'll talk about that later.
And it's taking it seriously, and they have amazing engineers and technical people, and you got to live with them. You just got to learn to get along.
Bias question. You're a shareholder of Google, but which model do you prefer? Do you prefer Gemini? Do you prefer ChatGPT? What do you use more?
Yeah, I'm not an expert, and I do have bias, so I use Gemini because it works for me. When they first came out, I would run the same search on both and compare them, and the results were a little bit different. I kind of use it as a search. Like if I have to ask a detailed question, I'll put it in, but I gravitate towards Gemini. I mean, I've got it on my tab open, and if it doesn't give me a satisfactory answer, then I'll flip to ChatGPT, but I'll probably drop ChatGPT eventually if I don't find it incrementally better. And I don't for what I do. It may be better for some things. When I look at Arena LM, like this website that ranks models that are coming out, every new model is the best for a period of time. They all keep leapfrogging each other. But for my purposes, they're all pretty darn good. And I think eventually I'll probably just end up with Gemini. It's because I'm a shareholder and I am biased, and I know that.
You guys, I think I noticed that on your scorecards, by the way, amazing scorecards, but at the very bottom you said you started using AI overviews for your recordings on Spotify. I think you did 3 episodes.
Yeah, my sister did that. Yeah,
that was pretty funny. I started opening like, oh, they're recording, and then I open and I recognized the AI overview. I'm like, I see he's trying his tool as a shareholder.
Well, some people just like to consume different ways. Like I walk a lot. On days where I don't work out in the gym or cycling, I go for walks, and sometimes I'll just go with my mind, but most of the time I just listen to podcasts. And so same thing, if I can give it to someone in a way that they don't read, or maybe somebody's dyslexic, they prefer to listen to it, why not? I think they're great tools.
Yeah, AI. So AI, the hype is going. People are saying there's an AI bubble, there's a circular founding, but if we scroll back a little bit, I think when you started your fund, you've actually first wrote a piece arguing using Meta, I think in 2012 or 2013, and I think then you used Apple the following year as an example of overall companies that just don't make sense to you. And then a year later you buy it. Yeah. So I think Apple was the example. So I think you had like a huge shift, and I don't think valuations changed that much from what I looked. I think at one point it didn't make much sense, and I think it was a little ironic. I know 1 year after year you had Costco as an example, and since then it's done phenomenally, and I don't think the thesis changed. Then you had Facebook, then you had Apple, and then you bought Apple. And then later you bought Facebook. So did you go through a kind of transition period there, like mentally? I know Buffett had his evolution. I know there's this concept of value 3.0 that's become very popular as well at one point. I think this was like pre-COVID of that capital light asset models are the future, and a lot of value investors were writing about it at one point. I don't know if that's what happened.
Yeah.
So if you can kind of
Yeah, well, I'll start with it. The value 3.0, I saw a lot of value investors who I like and respect willing to pay almost anything for these capital light compounders. I never got there. It killed me to pay 21 times earnings for Visa. It killed me. I did it, and it was just the right thing to do. So I think I've always been fairly disciplined in terms of my purchase price. What changed? So they're different. What changed with Meta? At the time they went public, they probably had over 1 billion users at the time. They weren't necessarily monetizing it yet or very effectively. So I couldn't see it. and you could make the leap that, okay, they're going to find a way to monetize it, but sure. But what does that look like? And I couldn't see it. And I'm not sure that management could even see what that was going to look like. So if they haven't demonstrated what their business model will look like or their margins going forward, I don't know how you put a value on that, and the valuation wasn't low. But then it turned out to be an amazing business, and I got more comfortable with it. I could see how they were monetizing it and their growth rate. And then I'm like, okay, at this rate, yeah, okay, I can see that. So I became more comfortable with the valuation. With Apple, I don't know. I just think over time, maybe it was in my early days, I worship Warren so much that, it's tech and it changes too quickly, but he changed his mind on it. I think I probably bought it before he did. Maybe I'm wrong. I don't remember. I just got more comfortable with the stickiness of the name, and services started to really take off, which created more switching costs for consumers and better margin as opposed to just being a hardware company. And there was a price at which, at the time I bought it, if I remember correctly, it was trading at like 12 times earnings net of cash. It was just too cheap. Now, I was dumb in that I bought it and then I sold it way too early. That's probably been one of the biggest mistakes I've had. And I've owned Microsoft here too. I bought it right when I started the fund. It was trading at $27. It was trading on net of cash. It was trading on single digit PE. I remember talking to my dad about it. He owned it since the dot-com. He was like, it hasn't done anything for 10 years. I'm like, the stock hasn't, but the earnings and the cash flow have all doubled, right? It was because it started at such a high multiple. So look, I've talked about some of the mistakes I've made in this business. I think you got to have an open mind. That's one of the things I like to write, but I don't like to write about names. You have to do it, but it kind of boxes you in. It's like, okay, well, you said this about Apple. Well, yeah, I changed my mind. And I think at 12 times earnings, given the margins and given my view of the business and the pricing power, I think it's mispriced here. And so that's the beauty, is you can wake up one day and realize that I was wrong. And you don't own the name, you can fix it. Or even if you do, well, even if you own the name, you can fix it. You can change your mind, and you gotta try and stay mentally flexible in this business. And you don't want to be changing your mind every day or you're flip-flopping. But you got to keep challenging what you think and about a company or industry or the world, because you get surprised every day. And I just thought it was a good bet. It worked out.
I think, just to give context to the listener, I think for Facebook, I think they went public 2013-ish, if I'm not wrong. And I think at the time what they were monetizing was the panels on the sides of their Facebook on the My page when you would go to the search. And I think at that point, 2013, that was the mobile revolution. Right. So I think when you started writing about it, I think it changed as could be wrong, but I think at the time they didn't have a mobile. I think it was just acquired Instagram.
That sounds right, Daniel. Yeah.
And then I think they finally figured it out.
So they could have missed that shift too, right? If TikTok was around then, they weren't. But if they were, and they didn't own, I can't remember if they owned Instagram or not at the time.
They bought it around a year or something like that after, yeah.
That company was much more vulnerable at that point in time to a TikTok coming out of the blue. And
well, they were vulnerable to Instagram, right? They bought it.
I know, the government tried to prevent that. And it's a good thing they bought it, right? Because I think the old Facebook is my parents' generation using it, but not as many people. Technology does change. Yeah, I like to see the cash flow. I like to see a proven business. Maybe that's why I gravitate more towards proven businesses. Buffett or Munger was asked once, well, when you interview a CEO or a CFO for one of your companies, why don't you get some of these up and comers as opposed to somebody who's been in a similar role and has an established track record? And I think it was Munger. So we don't do that. He said, what do you mean? We don't do that. We can't evaluate that. I want to see what they've done and how they behaved. Otherwise, I can't really predict what they're going to do in the future. And I think that applies to companies too, that there's a lot of these really early stage companies that I don't think exactly how they're going to play out. That's just not what we do. That's more venture capital or aggressive investing, and that's just not what we do. There's nothing wrong with it. I just think you're taking on different risks. And venture capitalists, I'll get the number wrong, but isn't it that they lose money or break even on 80 or 90% and then they have a home run? I don't want strikeouts, right? I don't ever want one of my companies to go to zero, and I'll give up some of the upside, but I prefer to make safer bets. And that's just how I invest and who I am.
Rule number 1, don't lose money. Rule number 2, don't forget. Rule number 1, right?
Absolutely.
Yeah, I think I found also fascinating that you've owned all the big tech. Well, you at least talked or owned the big tech. I think you wrote about Amazon. You've owned Microsoft since you opened your fund, or right about the time you opened it. You owned Apple. You owned Google. And I
I've
think,
never owned Amazon. I've never owned Tesla.
but you have talked about them all. So you have
Of
looked at
course.
you've looked at least at all of them, and I think you've seen the progression. If you've owned arguably the three better businesses, again, you could argue AWS and Amazon, and I think my question is, what it stems why I'm rambling about this is, you talked about valuations, and I think the problem was when you bought a lot of these businesses, they were on the lower end of valuations, and they climbed up,
Yes.
and I think you sold them, and you said it's too early. Has your opinion changed on owning companies that are absolutely amazing, but that just keep going up in valuations? And if it has changed, how do you still dictate when to sell?
Yeah, I think my thinking on it has changed. If it's a compounder and is look at Visa. Visa is going to grow at double digits as long as they aren't disrupted. And so if from time to time it becomes a little bit overvalued, so what? And Munger talked about it with Costco. This is the example he used. I could never get there with Costco on valuation. If you own one of these amazing businesses and it's growing at a good rate and the thesis is intact, even if it's a little bit overvalued, unless you have something way, way better, why are you going to trigger that capital gain and interrupt that compounding? Just let it compound. And sometimes it may not grow as fast as the market, and that's okay. Um, with Microsoft, when I sold it, it didn't look cheap anymore on paper. And I probably was a little more stingy on valuation when I started the fund in the early days. I did not perceive the shift to the subscription model and the cloud model in Satya, what he did. I mean, when I bought it, Ballmer was still CEO and he spent $6 billion for Nokia, which it was a ridiculous, it was a stupid decision. And so I'm dealing with this has-been tech company that's got this monopoly in Windows. It's starting to transform, and I really couldn't see it. But I think, one of the things I say to my colleague Michael is like, if the next time I want to sell one of our compounders, come over to my house and shoot me. Just leave it alone. Now, if I have another opportunity that's just staring at me in the face, that's way better, and it's Costco today trading at 50 times earnings or whatever it is. Like, it's a good business, but I don't think it's worth that. So I think you got to weigh all of that. But my bias now is especially for the best businesses, I want to own 17 to 20 of those, Daniel, and then just not do anything. I just want to let them run, right? And it's hard to buy these great businesses at a reasonable price. But when you get it, I should still own Microsoft today. And if I did, our portfolio would look a little bit different and our returns would be better. So I do try and learn from these mistakes and try and get better every day. That's all you can do.
Amen. My question, though, also, as the law of large numbers gets big, as these companies get bigger and bigger, especially the high quality compounders, at one point, they're competing against the law of large numbers. Like, how much can they keep growing? So how do you deal with that as well? I know, if we even look market caps in the early 2000s, the biggest company in the world was nowhere worth $1 trillion, and today we have multiple $1 trillion companies. Yes. So how does that all fit in your brain?
Well, I think you have to ask yourself, company by company, can this business continue to grow at this rate given their size? And I'll give you an example. Like, Visa is probably my favorite business. You still have the shift from cash to paying with credit or online. You're still getting the people from being in store using cash to paying online, where you can only use Visa or something similar. Personal PC, what is it? Personal consumption expenditures grow faster than GDP. I think it's 6%, so that's a tailwind. They have operating leverage because their costs really don't go up every year, but volumes continue to go up. I don't see any reason why Visa can't continue to grow at double digits for a long, long time. And if that's the case, then it's worth more than 20 or 25 times earnings. A Google, on the other hand, is getting really big. The shift from traditional media, print, magazines, broadcasts to online is starting to mature. So that's going to slow down the pace of that shift. It's going to continue, but it's going to slow down. Google's gotten a lot bigger. So can they continue to grow at that rate? Maybe not, but they're growing. They were growing at 20, 30% a year. Now they're growing at low double digits, which is still pretty good. I think over time, that's likely to become a mature business. See how AI plays out. Maybe they get more value from Waymo. I know they own SpaceX in their portfolio. That's a one-time hit. So I think you got to continue to ask, is the growth rate going to come down? And if it is, if a business can grow at high single digits for a long period of time and grow its earnings at that rate, that's a compounder that you don't want to touch. But if it's going to get down into the mid single digits and might be cyclical if we go through a recession, that might be a name where I might not hold it forever. There's a price at which I might sell it if I've got something more intelligent to do. So I think you got to continually ask yourself the question, is this the best place for our capital? And just keep challenging your assumptions. Just because something has grown at 10% for a long, long time doesn't mean it will continue to. You got to keep challenging those assumptions.
For Google, how do you fathom their huge expenditure on AI? Because I know they spend a lot. They are better than other companies in a way that the hardware costs, because they have their TCUs, and they could one day monetize that. But they're spending more and more. The industry is going to a frenzy. And how do you deal with it? Because the valuation at the beginning of this year, when they had the antitrust laws, maybe the valuation was around 19-20x. Now it's over 30, around 30, I think, hovering somewhere around the 30 range.
Well, a little bit lower if you back out the cash, but yeah, it's in that neighborhood.
So how do you deal with it? What if they keep spending money? Because historically,
I think they will continue to spend money.
Yeah.
Go ahead.
Historically, Sergey and it's blanking. The two founders have been poor capital allocators, and I know they brought the new CEO is a lot better. Well, he's been there for a while, but the frenzy, especially if you're living in the middle of Silicon Valley and AI is all you can think and talk about, what's stopping them from spending more? What's going to hit your thesis?
Yeah, I mean, Larry Page and Sergey, one of them said, AI, we cannot miss a shift, and we will bankrupt the company before we miss the shift, which worries me as a shareholder. And I think they were right to call it code red a few years ago when ChatGPT beat them the market. They should have been the leader in this. They were positioned to, and they missed it. But they've caught up, and I think they're in a pretty good spot now. So I think they're going to continue to spend on CapEx at an aggressive rate. We have modeled what that depreciation schedule looks like. Now, Michael Burry and others might take view, is it really a 4 or 5 year depreciation? Given that Google or Alphabet can reposition these chips, they don't have to be, they can just be doing traditional search or some of their other functions. So I think the expected life utility of these new chips that they're spending money on is probably about right for them. I think they can grow into their increasing depreciation costs, given their growth rate and given their market position. But I'm watching it. And so if it goes to 40 times earning and they start spending like Zuckerberg or what Oracle has done, I would be more concerned. Some of these, I don't know if we're in a bubble. I don't know if this is going to be like the fiber build out of my generation in the late 90s, where people are they're overspending and we won't know it until the bubble bursts and demand declines. But currently, they can't keep up with demand. And so I think it's rational to continue to add capacity to keep your position in the market. And let's say that the market does decline. I don't think these things are going to go bad. Google's going to be able to repurpose them in their core business. Yeah, there might be some value destruction. But I think it's better to be measured like they are being, but it's a risk. It's a risk that maybe they overspend right now. But I think they have certain advantages because of the diversity of their business and their distribution that I think they're likely to be one of the winners of AI. And I don't think AI is going away. Might not hear about it as often as we're hearing about it now, but I think this is a technology like the internet that is here to stay. And I think that they're going to want to be a part of it at a minimum, just to protect their search. Because I think these agents or even Gemini, I use it like search. So you're going to have, that's going to be my new search bar eventually, I think. And right now it's going and it's doing traditional search. So that the two of them, I think, are going to probably marry over time. So I don't think they have a choice. It's a bit of protecting their flank, but I worry about it. Are they overspending? And, if it gets to 35 times earning, is there better places for our capital? We should think about that, because even the best of businesses are not worth an infinite amount of money.
That's fair. How do you think about regulatory issues? Because they had the antitrust case in the EU. They had the case overturned in the States. Well, overturned, they did lose it. And the context for the breakout, though, I will say one quote, I think Rockefeller was very famous about talking about the spin-offs of Standard Oil and how, Standard Oil became a much more valuable company after they lost the antitrust cause than before, especially than before
Right.
they think. There's a double-edged sword here. Like, first of all, that regulation's always late to the party. So when it was really an antitrust case, would have maybe in the 1800s, towards the end of that point when kerosene became inactive, the oil industry was a lot more, we'll call it diversified, and it wasn't as a big a monopoly. You can make the same case now with Google, same parallel, that they were a monopoly in search, and now technically you could make the argument that they're not the total monopoly on search because of ChatGPT and people using LLMs to search. So how do you view the regulation? How do you view this concept of a breakup? How do you view them? Are they still a monopoly in your eyes?
Well, they're still dominant in search. I don't think there's any doubt about it. Part of where we added to the name over time was the judge in the U.S. handling the search antitrust was Judge Mehta. We were monitoring the proceedings closely. We were reading some of the pleadings and the reporting on it. Our default was that when they lost the case, was that they were going to be prohibited from paying for placement I knew that they weren't going to be allowed to be the default anymore. You couldn't pay to be or not default, to be the sole provider. They could no longer be exclusive. I knew that was off the table. I wasn't sure whether or not they were going to allow to continue to pay to be one of the choices. I thought we were going to go to a choice screen. And it turns out that the remedy was actually way better than I thought because of you just said that the Geminis or the OpenAIs are starting to potentially challenge them in search. So I never thought the business was going to be broken up. If it was going to be broken up, it's not ideal. That you can make the argument, well, maybe the pieces are worth more. YouTube's worth a lot of money. I'm sure Waymo is going to be worth a lot of money, but there are benefits to having it all together. So I thought it was going to be fine and not have the worst case scenario. Look, technology changes. I remember when Google started. I still remember when I used one of my first Google searches. I was a lawyer at the time. Someone said, you got to try this out. I was amazed that how quickly the search came back. But prior to that, it was probably Netscape or something like that. So a competitor can come out of left field and hurt your business. When it comes to regulation, that's probably one of the biggest risks for some of our companies. Google, yeah, maybe. I mean, the Europeans really like to regulate, and they spend a lot of money on lobbying. And Visa is another example where Europe has capped exchange rates. If North America ever capped exchange rates, Visa would be worth considerably less. I don't think they're going to cap exchange rates because I think the politicians are in the pockets of industry. I think that they lobby, and the money that it takes to be a congressperson in the U.S. means they're reliant on being funded. And so industry funds them. They lobby, they pay them to run as politicians, and in exchange, they just kind of leave them alone. And that's, you may argue it's right or wrong, but it is. That's just the way of the world in the U.S. And I think their position is going to remain that way. So you always got to worry about regulation. I do think about it, and I follow it. Dick Durbin in the U.S. has always been really harsh with payments businesses. And they passed the Durbin Amendment, I think in 2008 or in 2010, that capped interchange for Amex for Visa and MasterCard on debit. But they found other ways to get paid, and they started using signature Visa. So these businesses are crafty. But look, if a regulator or government ever wants to take on a business and crush them, they can. So you got to take that seriously, but you also got to judge what's the likelihood of that actually happening, despite what politicians say from time to time. And I think the drug industry is another example where they fund industry so much that I don't think the politicians really want to crush these businesses. They want to be seen to be being tough on them, but actually taking them on and destroying them usually doesn't happen.
That's fair. So for payment networks, you keep mentioning that you're interested in this Israeli company. I think it's ticker SHVA. It's automatic bank payments, if I'm not wrong. So what drew it to you?
Services, yeah.
So what makes you so interested? You alluded earlier that you're not super happy with the direction they're going to. Of course, full disclosure that I may or may not also have looked at it, and we may both or may not own the position, so we might be biased a little bit here in this discussion.
Yeah, and I do own it. I didn't even know, but I'm a payments nerd. I didn't even know about this company, and I was at ValueX guys conference, and it's actually the only idea I've ever bought from that conference. Most of the time I'm going, we're talking about stocks, and these people are friends. But a friend of mine from Israel talked about it and never heard of it. So I'm like, as soon as I get back, it's the first thing I do. And what I learned was Israel, a little bit like Russia we were talking about earlier, some countries want to control their payment network for geopolitical reasons. So this is a government mandated monopoly in terms of the switch in the country. You want to use a payment card, you got to go through their switch. And so no one's, or very few people have ever heard of it. The government wanted to bring in MasterCard and Visa to create a competing switch. MasterCard and Visa looked at it and said, no, we'll just buy 10% of this company, which was the max that they were allowed to under law. The company went public, much like Visa and MasterCard were originally owned by the banks. And then when they spun them out, they became more valuable than the banks. The business itself is just so good. And when they became a public company, they were also married to the central clearing payment system in Israel. It's a different business called Masav. It was being separated. When you separate two businesses that shared a lot of computer infrastructure and people, you're both going to have to incur additional costs. So the P&L, they were starting to, it didn't look as good. It was messy. But the core business was so good. Margins, crazy. I forget, like 40% margins, no debt, like hundreds of millions of shekels on the balance sheet. Sleepy kind of company like Visa and MasterCard were before they were spun out. And then they became these amazing businesses once they had, were out on their own. So I kind of saw some similars there. And when I did the math at the time we first bought it, I think it was trading on 12 times earnings net of cash. And, there's no reason Israel shouldn't grow at mid-single digits and payments grow a little bit faster than that. And so it was mispriced. And it's a compounder. I think the Israel economy, like almost every country in the world, is going to grow at a reasonable rate over time. And Israel was late to digital payments. They're still starting to put it in different places like Subway and gas stations and things like that. So volumes are going to increase. So it just had tailwinds. I thought it was going to be a compounder. Now, management diversifying away from their core bothers me a little bit. We bought it before the war broke out. It's still been a great investment because it was too cheap to begin with, but I didn't anticipate that. And their economy has been hurt by it a little bit. They're starting to diversify a little bit, and I don't know. They're spending a lot of money, and I don't see any revenue from it. I think ultimately, I think it's going to be an okay investment, but if management continues to not get traction, spend money and not get traction on some of these adjacent areas, then I don't know that we'll own the name forever. I wish they would just focus on their core, and I wish they would raise price. Their costs have gone up a lot because of the separation, more than they had anticipated, and I think Iran had started targeting some of their networks, so they had to spend incremental capital. Well, you should be able to raise prices a little bit. I know your customers aren't going to like it, but your costs have gone up and your margins have gone down. So I think the business will be fine, but it was just an interesting situation that at the price we paid, I know this, I just knew it was too cheap. That doesn't happen very often, right? So it was, it's been interesting to learn about the business, to be honest. It just helps me understand Visa a little bit better and MasterCard and Amex.
You can see the KH Internationals, though, because I think they have the recordings that are in English, that they do record. I think they pre-published the English, even though it is delayed from the Hebrew ones. Were you impressed with Mention? I don't know if you had a chance to talk to them or not.
Yeah, I've talked to them a couple times. I actually want to go see them eventually. It's a small company. Management teams always want to try and do more, and they're ambitious, and I respect that. But I think that focusing on the core business and executing well on that and taking price would be my priority. It's not as sexy, and I can understand why a lot of management teams want to do different things. Look, they may ultimately prove to be right in making some of these. They're trying to sell data, which actually might be a good idea, but I just see from time to time them spending a lot of money without much to show for it. And if they're doing that with a pretty good return coming down the road, then I don't mind it. But the jury's out whether or not that's going to turn into a decent return on capital. It's still small relative to the core business. And the core business is just so good that I'm okay with it at this point, but I'm watching them. And I think that we aren't the only ones who have given management feedback. And I think there are companies or there are investors closer to the company that have put pressure on them, as I understand it, to not carry as much cash. They carry way too much cash. And so they paid a special dividend last year. I think that they just need a little bit more discipline, and it's kind of a small cap company, but the business is awesome, and I hope this management team succeeds, and I hope they are successful in some of these other ventures, but I would rather a little more boring and focus on the core business and just pay it all the excess cash, because I think we get a better and lower risk return.
I think the fable of trying to diversify as businesses grow, and a lot of businesses have trouble staying with the one part that makes the money and just doing that part. As you said, everyone wants to have a little legacy. You look at a lot of companies, and a lot of companies could be curious that way. Do you talk to management? Do you kind of push them towards that direction? Hey, listen, maybe it's better to buy you back your own stock. Maybe it's better to just give out a dividend. Don't diversify into this business. It's not going to help you.
Right. The best companies have done it. Coca-Cola did it in the 70s, and when Buffett owned it, and Amex did it over the years with Shearson, Lehman, and some other side ventures. I talk to management on occasion. I talk to IR on occasion. I don't think I have any pull, Daniel. I try and be respectful, but it's a little bit like the young analyst telling a management team how to run their business. They think they know better. And all I can do is, when I think they're making a mistake, to politely and respectfully say, I think you would be better served by doing this, but it doesn't mean they're going to listen to me. I think ultimately I'm not an activist. I've seen some situations. I actually thought about it early, and when I started the fund, there was one company, it was a Canadian company, where I wrote a letter to the board, and they politely told me that, there's the door. I was right. But I think it was right. But I don't think I wanted to get into a nasty public fight with it. It's not worth it. And it takes a lot of time and energy and emotion, and I just don't want to go there. I think if ultimately I don't like what a management team is doing, I'm gonna vote with my feet, and I'm gonna sell the stock, and I'm gonna move on. I just think my clients are better served, and I'm better served not wasting the brain damage and the emotional energy fighting with somebody who doesn't think I'm right anyway.
Would you ever sit on a board, or not as a your personality, rather just be?
I don't know. Sitting on a board kind of ties your hands. I think that might be better for after I'm no longer actively managing money for outside clients, because if you sit on a board, you have inside information. You can only trade at certain times, and if I ever decided to sell the stock while I'm sitting on the board, I mean, you're not going to be liked around the boardroom table. So I don't think it's prudent to do that. If I was ever asked to sit on a board outside of a company that I invested in, I might. I don't know that I would say no if I thought I had something to add. I don't have the capacity at this point in time, but again, maybe when I retire, it might be something that I do if I'm asked. I might not be asked. Again, I don't travel in those circles in Toronto or generally. But as a banker, that was one of the most fun things, was getting to deal with the executives and the board and seeing how what how they operate and what they really talk about. And I think strong, independent-minded people around the boardroom table with legal skills and capital allocation skills, which isn't necessarily what a lot of management teams are experts at, can be invaluable to a company. So maybe someday, I'd never say never, but I have no current plans to sit on a board, and I don't sit on any boards.
A little personal question. You keep talking about retirement in passing here and there. Do you plan to do this forever until you want, or do you think once you feel that you need to pass on, you'll go to a different career path?
I don't think I'll do this forever, because it's exhausting, in a good way. Most days. I mean, some days it's just I'm tired. You know what I mean? No, I cannot do this forever, and I don't think I'll have another career. I think this is my third, and they've all been really good. I think I'll probably always, at a minimum, manage my own money, and just because I find it intellectually stimulating. But to be fair to my family, there are parts of the world I'd like to travel to and have more time to do those kinds of things. Or, one of my passions in life is reading. And I even though I read all the time, I don't get to read everything that I want to read because I'm dealing with other things. And, when I retire the first year, all I'm going to do is read and travel. I mean, it's just, I joke with my sister. I'm like, I'll bet you I could read 300 books a year if I finally retired. There's just so many more things that I want to do before I'm gone. That, I won't do this forever. And how long I do it for, I don't know. At this stage, I like getting up most days and doing it and working hard and trying to deliver from our clients. But no, I'm not gonna pull a Buffett and retire at 96 or Munger at 99.
Yeah, that especially working intellectually in that capacity, I think that's the most inspirational thing they have done. I have no idea how they do it. God willing, I'll be able to do that too. Gonna pivot a little back. I think you at one point too kind of like maybe rub your nose in one little mistake and then, or maybe not a mistake, maybe a question, and then maybe we'll pivot to exchanges. I was following your quarterly reports, and at one point I was very curious. You bought Intel, and I couldn't find full rationale why. And then I know you exited really quickly. And my question was, first of all, what happened there? And then the other follow-up question was, what do you do when a stock goes up really fast, or you sell really fast after you buy it? Like, how quick can your thesis really change, and you can just be okay letting it go?
Yeah, if it's a compounder and the stock goes up, I wouldn't do anything about it. If I'm renting a name, like where I think it's just mispriced, but it's not a business I want to hold long term, I might sell it. Intel, I thought my thesis was that they could get it back. Gelsinger, I think, had just come in and was saying the right things, and he thought that they could get back on track in terms of the next nodes. And so I owned it. I think when I sold it, we made money. But I remember I was at a conference in Dubai, actually. My buddy Nanad from who's in the UK. We talked about it, and he looked at me, and we talked about Intel. I said, yeah, I think they can get it back. And he says, not a chance. There's not a chance he's going to get it back. And he knows semiconductors in this space better than I do. And so we talked about it a lot. And at the end of the day, I'm like, you know what? I think I'm fooling myself. I might still be right. They might be able to get it back, but I'm over my skis here. I'm outside of my circle of competence. That's really where I came to that. Mike, you don't know, you think you know what you're doing, and the numbers, the cash flow was interesting. I don't think you really have a high conviction that these guys can turn it around and, become a fab to the rest of the world, like a TSMC. And so I just changed my mind. And like I said, I think we made money on it. But I think I realized that, no, it was outside of my circle of competence, and I just didn't have the conviction that it was going to work out. And I think it may have worked out, but for political reasons and not reasons that I had saw. I think you just got to keep learning. And if you think you made a mistake, you deal with it. You sell and you move on.
You looked at semiconductors since, or you think you'll just not touch it?
No, I not that one. I've looked at TSMC. There was part of me that wanted to own TSMC because it looks like such a good business and such a good moat, given my view on Intel not being able to turn it around. But I worry about the geopolitical risk. There are a few stocks on my watch list that are the capital equipment suppliers to that industry, the tool makers, where I think they're really good businesses. We almost bought one. Michael and I actually had a slightly different view in terms of what the best entry price would be, and we missed it. But they're still in that space. Look, I love businesses with tailwinds. Do you think we're going to need more or fewer semiconductors 10 or 20 years from now, Daniel?
More.
So if you can find a business that sells the picks and shovels that is unlikely to be displaced, it's got tailwinds and it's cyclical, right? I mean, that industry has notorious cyclicality. If you can buy it at a reasonable price and then just leave it, that in 10, 20 years, you're going to make a lot of money. So yeah, I would invest in the sector, but the software companies in that sector too, the Cadence and the Synopsys, I think are amazing businesses. Again, I haven't got my price, but that would be a way to play that tailwind that I think is very, very interesting. But we don't own anything in the sector currently.
I have a little thesis. Maybe, I'm leveraging you a little too much here. Maybe you can poke a hole at my level one thinking about the semiconductor business. Sure. But at one point, well, disclosure, I have owned or have owned. I've looked at my idea about the semiconductor business, especially the fabricating companies, that each node we keep going on, the amount of capital needed in order to get into this business keeps going up exponentially. And we're not talking even about human capital of expertise in order to get everything running, because that's even out of the question. Like even the monetary capital just to get it off the ground just keeps going up. And at one point or another, only governments can even attempt it. And at one point or another, I thought that if you own, I think the industry will consolidate to maybe one or two players max. And I think on the fab side, I think there's going to be maybe one or two or three, because the technology, how to get there, the expertise is just getting worse. Is diminishing people who can do this. The more expertise needed and more capital needed to keep going down these nodes. Like the machines they have right now, I might know the name you were talking about, but lithography machines that they're making in order to make the actual machinery to make the chips and get them so small, it's just becoming more complex. So at one point I had a thesis that, level one thinking without even going deeper, but because of this basically going down the hill of capital required to enter the business, and in order to remain profitable, and I think margins-wise, TSMC, I could be wrong, has around 30-40% margins, depending on who they're trading with, the contract. Samsung has a bit lower margins, but they also are on a bunch of other businesses. They're truly a conglomerate, but I think these two players, I don't know what's happening with Intel. I kind of put that into too hard pile because I don't know there's too many. There's political risks. The government owns 10% now, apparently. I have owned debt for Intel because at one point, it was a while back, it made a lot of sense because it was trading at 70, 60 cents to the dollar, which did not make sense.
Okay.
But the two main equity ones, I did own Samsung and TSMC. This is just the level one thinking of the thesis because of the capital required to get there and to maintain it and the expertise.
But don't you think the industry's already there? Like I only think of those two companies and maybe Intel, and there's another one in the Middle East, but it's...
But there's a lot of I know Europe's tried to get their own going and they failed. There was a couple other divisions that started going it. Yeah, no way. I know AMD sold their fab business. That was a while ago.
I think the industry's already there, Daniel.
You think?
Not at least on the leading edge. There's TSMC, there's Samsung. That's about it. Intel is a couple nodes behind. On some of the trailing edge, you've got the Texas Instruments of the world, and the Chinese are starting to or play more and more aggressively in that space. I think at the leading edge, for the reasons you've cited, I think the industry's already there. I don't think that there's going to be any new leading edge player. For geopolitical reasons, I think the U.S. should try and get TSMC to build these fabs.
Well, they have the one in Arizona.
Yeah, you have one. How many do they have in Taiwan?
Yeah, that's fair. And they might have more coming, but I don't think there's going to be more. Like, I think those two players are safe because of that reality. Because they might screw up, like Intel did, drop a couple nodes, not focus on the factory. But I think because of this consolidation, you're pretty safe with the two. Maybe not growing, double-digit returns safe.
No, I think TSMC is an amazing business. What I worry about is China is going to take Taiwan eventually. So what does that look like? What does your investment look like? I mean, the world's got a problem then because you've got the sole supplier of all the leading edge chips. I don't know what percentage comes out of Taiwan, but it's a lot. And they want that. The Taiwanese want that because they want to have the Americans and other nations so reliant that they're going to protect them. But let's assume that China reunifies, as they've said publicly that they're going to. What happens then? If China is prepared to use rare metals, to push back on some of the tariffs and things that they don't perceive as fair to them, what's to prevent them from doing with semiconductors? And they will. So if I own TSMC, what does my investment look like? I don't know. Do they nationalize it? Maybe. So I wouldn't invest in it for that reason. Now, maybe that won't come to pass because I just didn't like the geopolitical risk. But I do not fear a competitor coming in and displacing them and their ability, or an ASML, who the heck knows? Maybe the Japanese are trying to come up with the next technology to make the nodes even smaller, but who the heck knows who's going to do that? This is just, I think the players that have won in this space are going to continue to keep their lead if they continue to do it right. And TSMC starting from zero, was it Morris Chang? Was that his name? Like it's incredible what they've built. I give them full credit for what they've done. And I think given what's happened to Intel, I think they've learned the lesson. We're not going to be complacent like they were and miss the shift to, in their case, Apple or whatever the next node is. I think they're an amazing company. I just wish that they were based in Ireland, off the United States, where I wasn't worried that something bad might happen to them, because then I'd be able to invest in it. But yeah, no, it's incredible that humankind can build these machines. Like it's a miracle. It really is. And we take it for granted. It's in all our devices. But if we lose that supply, or somebody can restrict that supply, boy, the world's in for a real shock.
That's fair. So I said we're going to pivot to exchanges. I don't know if you might need to go. I don't know if we're over our time. So if you need to go, we can cut this short. Just let me know.
I've got a few more minutes, Daniel. No problem.
So if we quickly, I know you invested in exchanges. You left because you felt they were valued. You were asked on different podcasts if you would own other exchanges. So
Sure.
I know your thesis there relied heavily on the derivative business, unless I'm wrong. So how do you...
CBOE you're talking about?
Yeah, I think so. But you said you also looked, again, I could be misinterpreting. I'm kind of trying to read between the lines, that you have looked at other exchanges. So when you're analyzing exchanges and looking globally, what do you look for? Because, for example, I can bring an example. There is the Polish exchange, GPW. So I forget the full what they stand for, something partner group.
Okay.
But they own the Armenian exchange. They own the derivative business, the bond business, and the equity business. So there's like other exchanges like this that have monopolies.
Sure.
And because they're a government-mandated monopoly as well. Because and then it's a network effect, something you like. So what are you looking at in an exchange?
Yeah, so we have owned CBOE, and I did sell it because of valuation. I still think it's a great business. They made some dumb capital allocation decisions. Like I think they bought some crypto business for 200 or 300 million, which they vaporized within months of buying it. But liquidity begets liquidity, and if you have a dominant franchise or a monopoly in a certain area with pricing power, that's a good business, and it's unlikely to go away. I think the equities business has gotten worse over time because of regulation, where now you have alternative exchanges and it fragments liquidity. So those businesses are not quite as good. We still own the Intercontinental Exchange, ICE, in the portfolio. And I think years ago, this might have been before GreensKeeper, I've owned TSX in Canada previously. I think the equity cash trading business is not as good anymore. It's becoming more commoditized. So I don't like that one as much. I do like the listing business, because usually there's only one or two exchanges, NYSE and NASDAQ in the US, where people want to list. That part of the business is a good business. Exchanges have really become data businesses. And if you have, in the US, the best execution rule. So when I trade for clients, I need to know that I have access to every single market. And I need to see the data, and I pay for level 1 or level 2. I want to see the depth of the market. It's expensive, even for a small firm like GreensKeeper. It's obscene what we pay in data fees to these exchanges, and they increase price every year. And okay, I gotta pay. I have no choice. And the incremental cost for them to sell that to me is like zero. So that's an amazing business. Another great part of the business, if you have proprietary products, like CBOE they're a dominant options exchange, but they cleared their own options. So the clearing part of the business, when you clear your own trades, that's another very good part of the business where you can't clear it anywhere else. They've got a monopoly in that clearing. So those are the kinds of attributes that I look for. Is this exchange primarily a cash equity exchange that's competing with other people? Like I forget who it was. It might have been CBOE they started buying a bunch of equity exchanges in Europe. And Amsterdam, but there are so many multiple exchanges.
NASDAQ. Maybe NASDAQ.
Oh, maybe that's what it was.
I think NASDAQ. Yeah.
When an equity could be traded on multiple markets, you don't have much pricing power, and so you're going to start to lose volume, and it's not as good a business. But if you have the other attributes where you have unique contracts, CME is another good example where they have very unique contracts that it's like the standard. If you want to trade, I don't know, I'll get this wrong, Brent or a certain interest rate future, everybody goes there because it's the most liquid market. So everybody goes there, and then we'll keep going there. And if you can create that local monopoly through that network, it is a network effect, right? Where liquidity bequests liquidity, then you can charge for it. And it's going to, volumes continue to grow. So those are the attributes that I look for. And then I just look at price. Usually exchanges are not cheap, but from time to time they fall out of favor. We've looked at London before because I think they've lost a lot of listings, but They still have a very interesting data business. They also bought a business similar to Capital IQ. I forget what it's called. They bought it from Thomson Reuters years ago, or maybe they bought it from someone who bought it from Thomson. So that can be a good business. I just look for their market position, what I think their volumes are going to do in the future, and I look at valuation and capital allocation. Like, some of these businesses make dumb decisions. Today, ICE Intercontinental is the only one we own, but I think Jeffrey Spector, the founder, he built this business from nothing, and I think he's a genius. And now he's starting to take on the mortgage business in the U.S. It's been highly paper, trading a lot of paper and signatures, and it's digitizing it. I've used some of their stuff online, and it's quite good. And I just think he's got a view for good businesses and how to make money. So I have a lot of faith in that management team. So you're hunting in the right places, Daniel. These are good areas, and I won't go to Warsaw because I'm not as familiar with that part of the world. But given your background, you are, and can probably get more comfortable than I will be. And maybe it's mispriced. These corners of the market, if you're comfortable that the regulations won't change and that the exchange can continue to grow volumes, and that part of the world is going to continue to grow, stock exchange is a great way to play an economy that's growing, right? Its market caps of its public companies should continue to grow over time. I think it's a great place to hunt.
What I'm scared for is that they have a huge government ownership. So they have a government stake, because during privatization, I think a lot of governments would take, especially in concession companies. And I think they did treat the exchange as a concession. Again, it's been a while since I really led there. So that does scare me, especially when there's government on the board. It screams a little bit, gray area. But they seem to be making a lot of really good decisions. But yeah, I just was curious, why not? Well, I have you here. Michael,
for me, it would just be the jurisdiction, but I like, the Australia Stock Exchange I've looked at years ago. If I found the right exchange and the right jurisdiction at the right price, I'd be all over it. But when you talk about government ownership, I think the U.S. even took an ownership stake in Intel, and then, under the Biden administration, I don't want to be political, but under the Biden administration, under the CHIPS Act, anybody who took money then had to do certain things. I don't remember the rules, but you had to buy American or unionized. When the government owns a piece of your business, you're going to be politicized and you're going to be at their whim. And I don't like that. One of the beauties of the North American or capitalist system is you regulate where monopolies can form or companies are doing bad things. But other than that, let your populace create and businesses thrive and create what consumers want. Let the market compete. And if you're in an environment like that, that's where people thrive. When I've got somebody, if I've got a government as a partner, and especially as a majority partner in a business, that makes me very nervous because they've got a different agenda from time to time.
Especially with election cycles and new policies.
You know it. Yeah.
So we'll close. All right, Michael, before you go, if you were restarting your career from scratch, what would you do different? Okay. What is your regrets? What would you have changed? 15 years of GreensKeeper, 25 years in the industry. I don't think I changed a
thing.
Really?
I don't think I changed a thing. Yeah, no, really. I might have taken school a little bit more seriously. Like, I was a pretty shy kid and socially awkward in high school. So university kind of shocked me when I grew up a lot. And it was a very positive experience for me. I made some great friends and kind of came out of my shell. But maybe partied a little bit too much, which is why my daughter got into Ivy and I didn't, because I goofed around a little bit. But when I look at my career, Daniel, I learned so much I gained self-confidence in law, and I learned how to write. I learned how the world works and the rules of the game in North America. Investment banking was a blast. We made money, and I got to learn about capital markets and stocks, and I actually got to see how portfolio managers worked and some things that I liked and I didn't. So I got to learn about Buffett. That's really where I fell into Buffett, with one of my research partners. Introduced me. He was a big Buffett fan and introduced me to and I just, once I read it, it just gravitated, like it made sense to me immediately. I think that happens with a lot of value investors. And then GreensKeeper, I started with almost nothing under management, $3 million, and it's grown every year since, and it's still growing. They've all been fun. Like, I don't know how to describe. I've learned something. I'm infinitely curious, so I don't have regrets. That doesn't mean that I didn't have challenges from time to time, or maybe some things that I didn't like, but my life kind of turned out, and it wasn't this master grand plan. I think I'm doing what I was meant to do. It took me a while to get here, but everything that got me here, I still use it every day. And I like my life, so I don't regret it. You know, I really don't. I thought about that because I knew you were going to ask me that question. I don't have any regrets, and knock on wood.
Oh, that's amazing to hear. So before you go, again, I said that twice, but on Guy's podcast, you recommended The Payoff. Was an excellent book. I'm not quite done it yet. I try to read it between. What would you recommend? You know? Oh, you got it too.
Yeah, it was recommended to me by a fellow value exer, Leif Eric, who I didn't even know at the time. And he knew I was a payments nerd, and he said, "Oh, you should read this." It gets really into the moat and how these businesses work and what's powerful about them. And I read that before I wrote my Visa memo. It helped me to understand the industry a little bit better. What's your question? What to read?
Yeah, what do you recommend? You know, last time you recommended, you ended it with a great book, you know, so we're hoping maybe you'll recommend another good one.
So we on our website, greenskeeper.ca, we're in Canada. I have a bookshelf. I read a lot, and a book doesn't make it onto our bookshelf, our public bookshelf, unless I actually recommend that people take the time to read it. I think it'd start with that. I don't know. We probably have 100 books on there you can start with. I just go to whatever. I read recently the Almanac of Naval Ravikant. It's a really good read. He's very wise, and he said something in the book that he's a reader too. I think you just want to go to whatever interests you, and to be good at this, or even if you don't want to be into this, if you read just for the sake of reading, like I read so many weird things. You know, I read Courage Under Fire recently, which is Stockdale when he was shot down in Vietnam. It's just really, he borrows a lot from Epictetus and the Stoics, who I'm a big fan of. And it was just talking about his experience in the Hanoi Hilton. I'm reading my wife's biology textbook right now because I never studied biology in school. I find it interesting, right? Like how things work. I think you just want to just keep reading whatever interests you, and read broadly. Every night I go up and I lie in bed and I read. Like I don't watch a lot of TV. I watch a little bit. And I don't think that's the way most people spend their life. And it just depends on how you're wired. I like to learn. And if you like to learn, or you've got a passion for this business, I can tell you've got a passion now. If you want to get into payments, or if you're starting your journey in value investing, there's a bunch of books in there that you should read. You should read all of them. And you should just keep reading. I've got a spreadsheet of books that I bought that I haven't read yet. My anti-library, as Taleb would call it. I've got a list of books that I haven't even purchased yet. And it's like hundreds of pages long. Every time I read a book review or something catches my eye, I read a review on Goodreads and I'm like, do I want to read that? Yeah. So I add it to my list. And that's part of why I'm going to retire someday, because I've just got thousands of books that I want to read. And that's my idea of heaven, just an infinite amount of time to read and learn about everything. I just find the world so curious. So yeah, I just encourage people to read and spend your time wisely. I think we take it for granted. We've only got so much time in this world. There's nothing wrong with watching something that's mindless, just to tune off if you're really tired. And I do that on occasion too. But I would rather sit and just improve my knowledge of something because I find it interesting, and it's not work. And if it's work, then you won't do it. But I think you do that every day for decades and decades, and you'd be shocked at how much you can pack into your brain over your lifetime. And so I just say gravitate to what turns you on, whatever that is. You know, it could be fiction, could be science, could be philosophy. It doesn't matter.
I think that's a beautiful note to end it. Michael, thank you so much for coming. You know, you were very humble during the interview. Believe it or not. Well, for the users, we'll definitely have also gained a lot from the interview and from your writing.
I'll have to tell my wife and daughter that.
Thank you so much.
Thank you for the invitation, Daniel. And I'm excited to monitor your career. You know, as I said to you, there are some people that I follow and have mentored over time. And I think you have what it takes, and you have an intensity. I see it in even the emails you send to me. And when you have that and a passion for this business, you can be great at it. You know, time will tell whether or not you do this for a living or are great at it, but I think you have a shot at it because you have the right ingredients. You're curious, you work hard, you got a good mind, and I'd say just keep at it. And the money comes. Don't worry. It's easy to. I mean, you got to put bread on the table and feed your family. I get that. But my advice to you is a lot of other young people is you just want to get into this industry and then just gravitate to what you love to do. And the money, we all do well eventually if you're decent at it. But I'm going to be keeping my eye on you, and I'm excited to watch your progress.
Thank you so much, Mark. You're way too kind. Hopefully, you're always welcome back. Hopefully, us rubbing salt in your wounds all the time does not leave a really bad image.
No. This is fun. I can't do it again tomorrow. I got to go lie down for a little bit. No, listen, I was humbled by the invitation, and I like you, which is why I agreed to do it. So I'm excited to continue the conversation someday, Daniel.
All right. Thank you so much. You're always welcome. Hopefully, happy holidays to you, your wife, and your daughter.
Thank you. And to you as well. I'm glad you're back home safe and sound.
Me too. Thank you.